Hey everyone, and welcome. Today, we're going to break down something huge: how to stop trying to predict market tops and bottoms and actually start trading reversals like a pro, using a real structured framework. Let's jump right in. This quote just hits the nail on the head, doesn't it? We all feel that pull, that ego, that desire to perfectly call the turn and feel like some kind of market genius. But here's the hard truth. The market doesn't reward heroes. It rewards discipline. And this slide, man, it just lays it all out perfectly. On one side, you've got hero trading. That's all about ego, taking a wild guess, and jumping in with huge risk before the market's even shown its hand. And on the other side, process trading. This is built on confirmation, on patience, on waiting for the market to actually prove to you that your idea is right. Our entire goal today is to get you from that left column over to the right. So how do we actually do that? Well, we use a framework. Look, this isn't about hope or some lagging indicator you found online. This is a 5-step institutional approach, and it's designed to do one thing: get us out of the prediction game and into the confirmation game. Okay, so this is our roadmap for today, the 5-step process we are going to drill down on. It all starts with step 1, understanding the big picture, the higher time frame narrative. Then, in step 2, we learn the art of patience, just waiting for the price to come to us. In step 3, we start looking for those first little clues in the candlesticks. Step 4 is the big one, waiting for that liquidity sweep. And finally, step 5 is our absolute green light, the market shift. Let's get into step 1. First things first, you've got to know the bigger picture. Where is the institutional money actually flowing? Are we in a strong uptrend, a downtrend? See, the best, highest probability reversals don't just happen out in the middle of nowhere. They happen when price comes back to a major area of supply or demand. A level where a ton of orders changed hands before. You have to know where those zones are before you can even think about a reversal. And that leads us right into step 2, which, honestly, can be the hardest part: doing nothing. Once you've marked out your key supplier demand zones, your points of interest, your only job is to sit on your hands and wait. I love this bus stop analogy. You don't go chasing the bus down the street, right? No, you wait for it to arrive at your stop. Patience right here is literally your biggest edge. Okay, so price has finally arrived at your zone. Now it's time to put on your detective hat. Step 3 is all about watching the candles for signs that the momentum is dying. Are those big, powerful trend candles starting to shrink? Are you seeing these long wicks popping up where price tried to push but got slammed back down? Do you see a doji candle, which is basically a sign of a tug of war between the buyers and sellers? But, and I can't stress this enough, these are just clues. They are not your signal to jump in, not yet. Now for step 4. This is absolutely critical, and it's where most retail traders get completely wiped out. We have to wait for a liquidity sweep. The best way to think about this is like the market's head fake. It makes a sharp, aggressive move just to take out all the stop-loss orders from people who jumped the gun, grabbing all that fuel it needs for the real move in the other direction. And this right here, this is one of the most important rules in all of trading. I mean it. Read it, remember it, tattoo it on your arm if you have to. If you enter a trade before the market has swept that liquidity, before that head fake, then you're not the sniper. You're the target. Your stop loss is just fuel for the institutions. All right, finally, after the head fake, after the liquidity sweep, we wait for step 5, the market shift. This is it. This is our final confirmation. For a sell, it's when price smashes below a recent low. For a buy, it's a break above a recent high. This break of structure is the market literally screaming at you that the game has changed, and one side is now officially in control. This is your green light. Okay, theory's cool and all, but let's get into the good stuff. Let's see how this framework actually plays out in the real world. We're about to break down a single trade that pulled in over $250,000 just by following these exact 5 steps. So let's set the scene. We're looking at Euro/USD during the London session. Step 1, the higher time frame narrative was clearly bearish, no question about it. The analysis pinpointed a premium supply zone, basically an expensive spot in the downtrend, as our key point of interest. The trap was set. And here is where all that waiting paid off big time. Price pushed up into that zone, and then boom, just like clockwork, it performs a clean liquidity sweep, taking out all the early sellers. And almost immediately after that, it breaks structure to the downside. That's step 4 and step 5 checked off. The confirmation couldn't have been any clearer. So where's the entry? It was on a little pullback, a retest after that market shift. Now, pay very close attention to this next part, the stop loss. Where did it go? Not just above the entry, it was placed safely above the high where the liquidity was just taken. See? That is how you protect yourself. You let the market show its hand first. And the result of following that disciplined, patient, step-by-step process? $264,000. That wasn't luck. It wasn't a guess. It was the result of a repeatable framework executed with pure precision. You know, this quote just says it all. The profit didn't happen when the button was clicked. No way. It happened in the hours of prep beforehand, the chart analysis, setting the bias, having a rock-solid plan before the market even opened. The execution? That's just the easy part at the very end. All right, so you've got the framework. Now let's really sharpen that edge by layering in two more absolutely critical pieces of the puzzle: timing and mindset. Think of this slide as your sniper entry formula. It's when all the stars align. First, you need the right timing. We're talking the high-volume London or New York opens. Second, the right location, that supply or demand zone we already marked out. Third, you wait for that clear liquidity sweep. And finally, you get the change in structure, our market shift. When you get all four of these lined up, your probability of success just goes through the roof. Now, just as important as knowing when to get in is knowing when to stay out. This is your don't do stupid stuff checklist. Don't you dare enter before that sweep. Don't mistake a couple of small candles for a full-blown confirmation. Never, ever fight the bigger trend. And for the love of all that is holy, leave your ego at the door. So look, if there's just one thing you remember from all this, let it be this mantra right here. Stop trading your ego. Stop trying to prove how smart you are. Instead, just start trading the price. Listen to what it's telling you, wait for it to confirm, and then, and only then, do you act. So I've got to ask you, the framework is right here. The path from being a market hero who blows accounts to a profitable trader is all about process and discipline. It's about letting the market prove everything first. So, are you ready to make that shift?